All right, welcome back. We are live. Let's see. We're trying to stream on both Twitch and YouTube tonight, so that's going to be a little bit of a technical test for us. Gonna give it just a minute for some people to jump in here, hopefully, for this. All right, welcome. So yeah, we've got at least one viewer in here, so I guess we'll get things started now that we got one. So I guess we could start off by talking a little bit about obviously what's been going on the past week or so in the market. There's been a pretty big rotation. If we take a look at SPY, this is the 1 year. So let's zoom in a little bit here to the 20-day. And these were just some technical analysis lines that we'd previously drawn. We kind of tried to make the point that if these were, what we could do is we could extend these out to the right. That if SPY broke below this, you see it bounces off the bottom, bounces off the top, bottom, top. It would drop even further. And let's see, I think that's Thursday. That proved to be accurate. So when it broke out at the bottom of that, we did see it drop all the way down to 371 from the intraday high of 383. So that was a pretty big drop. And one of those things that's definitely a little bit scary when you've got a lot of bullish long positions in the market, but it quickly bounced back up and did again bounce off the top of this channel. So we did kind of draw these maybe about a week ago. This is something good to keep in mind going forward, and we'll probably be referencing these as we move along just to, I guess, keep an eye on where we think the market's going to move from a certain point, because that could help us overall with a lot of our trades. Keeping an eye on the Discord too. We just had something in there, but yeah, so when we look at the overall picture of the market, things are trending slightly downwards. We could see from the angle of the trend lines that we have drawn here, bouncing between these. We've seen a pretty big dip that was bought up pretty quickly, but one thing that is important to bring up is what was bought back up quickly. And so far the answer has been not tech stocks. And unfortunately we've had some positions in Apple and AMD, and these things, I mean, Apple, I think, is personally one of the just single strongest stocks in the market. And from the high, I think 20-day high is 138. I don't know if it ever got into the 140s. Yeah, so it peaked at about 145 January 26th, which obviously is great off a run like this for such a strong, large company. But off that 145 peak, it's dropped all the way down to 116. So it's about $30 off the highs. And I always think it's such a good strategy to, when the market is looking a little bit shaky, as we might be seeing right now, or when things start to pull back, it's a good idea to jump into safe stocks like this. And this is what we try to do. Unfortunately, we were pretty poor in our timing. So we saw the drop from here and we tried to get in, I think right around this date on this red line, somewhere in this area, because that was our break-even price. But long story short, it kept falling. And it's one of those where we do have a decent loss on paper right now from this, but our break-even price has gone from about 127 down to, I think, just over 125 in just a couple short weeks. So that's something we're confident we'll be able to keep pushing further down. Another stock that we're playing in a similar situation is AMD. And that one has also had a similar downtrend. Definitely one of what I thought was the stronger stocks in the tech area. So that was something that was kind of a surprise to see fall so far from the highs of $95. I think this might be another one that topped out near. Yeah, so it almost hit 99, or almost hit $100 rather, topping out at 99.98, and then falling back to 74.41. And if we look kind of at long-term trends here over the last 180 days, this 74 area should be a pretty solid entry. I think tech in general is an industry that's oversold right now. And I mean, being $15, $25, excuse me, off the previous high makes this a pretty solid entry point. Now, again, another one where unfortunately we ended up here at the red line. Our break even is now down to, I think, this area. So Still a lot of room to go, but we have ourselves open for a bounce, and that's something we're perfectly okay with, and we'll just keep holding on. Hopefully we do get the bounce that we could see from the potential support line here. And that kind of sums up, I guess, some of the higher level plays that we've been making. Another one that's taken a turn against us is LOTZ. That one, our break even, I think, is right around here. So, I mean, we don't need as significant of a jump. We had a jump up to 850 this morning, but that's another one where, just due to the nature of the stock and how volatile it is, we're not terribly worried. There's plenty of premium that we could roll into if we did want to take assignment. These April 10 strike calls are paying out 55 and 70 cents, so we'll call that low 60 cents per option that we would sell on those. So that would get our break even from 880 all the way down to 820. So that's not too bad for a little 1 month play that's turned against us. So, and again, it's still March 8th. We've got 10 days until expiration on a lot of these March series of options. So when things do get overbought or oversold, rather, they have a tendency to jump. That's kind of a little bit of the idea behind the strategy that we're running. Good question here. What do we think of Sony? Always happy to answer the questions that we're getting in the chat. So let me address Sony right now. And I guess their ticker is SONY. Are we talking Sony Corporation or Sony SNE? I guess that's them right there, SNE. And yeah, I think this does just count perfect. SNE, we've got it on there now. That is something that does fit the, I guess, characteristics of what we are seeing as a general trend in the tech area, where people have been rotating out. Obviously, it peaked at 118. Sony's a good company fundamentally. It's not some super risky penny growth stock you'd be throwing your money at. But I think anytime that we see a drop this steep on a company with this kind of a name, it's definitely a great entry point. I mean, maybe 180 days back, you could have a little bit of pause because it was trading around $70, and getting up to 120 is, I mean, almost doubling your stock price right there in a pretty short period of time. But again, looking at where we think a good entry point is, if we get down here, we see it maybe a little bit of support potentially here, where this previously bottomed out in the 94 area. That's kind of consistent with what we see from November to mid-December here. But all in all, a great entry point. And another indicator we really like to talk about a lot is RSI, which is the Relative Strength Index. And that tells us if things are overbought or oversold. And looking at the 180-day RSI down here in the corner of the screen, we can see that Sony has an RSI of 27.36. And in general, when you're evaluating RSI like this, the way you're going to want to look at it is anything above 70 is overbought. It's probably going to sell off soon. Anything under 30 is oversold. It's probably due for a bounce soon. And historically, we can look at whether or not that's been accurate. For example, we have a little bit of a peak here and nothing too severe. There's a little bit of a pullback in the chart after that. It got back into the blue right here. And almost kind of a similar looking setup as far as the way that it sold off over a similar period of time. And then, I mean, after that, I guess if you want to take a look at the broader sell-off, it went from just over 100 down to low 90s. And then this was January 29th. And within the week was back up to 120. Now, a lot of this was powered by strong earnings, but at the same time, something to consider is that if a company has strong earnings, probably is a pretty strong stock to be investing in. If you have another entry into a stock that it was trading at before it had those good earnings, I think this is a great way to look at it. And just from the perspective of what we do from selling options, we could take a look. But, you know, it doesn't seem like there's a ton of volume on this one. Decent returns, I guess, if you're looking at, you know, just over between 1% and 2% a week. I think these were roughly at the money. So 1.19% a week. Far out options. I mean, as far as what we do, we sell options, but this is one, we like to sell options on things that have solid premium. This is one that, you know, maybe doesn't have the best premium in the world. So if you were looking to buy a Leap or something because you wanted to do something that was a little more capital efficient and you were looking to 2022 or 2023. Yeah, I mean, a lot of these, I mean, I'm sure if you're asking about, January 2022, something like that, I'm sure you're familiar with, you know, how break-even prices and how the capital efficiency of Leaps works. I don't know if your game plan would be to hold these for a while and just try to flip one, but I don't think that's typically something that we try to do, because even if you did buy like a 100 or 110 strike call for 2022, I mean, the premium on here is $8 plus 110 would put your break even at 118, which is pretty much the all-time high. So not only would you have to get back to the all-time high within the year, you would have to go decently above that in order to make profit, which is why, I guess, from a setup of a trade perspective, that's why we typically don't like to buy options. So I think this is one, if you're interested in having a long position, just buying the stock might be a better move, and potentially incorporating some of the option selling strategies in the sense of, okay, we could start selling calls to cover those shares. So I think not necessarily purchasing leaps, but maybe just being long on the stock and then incorporating something like a covered call would probably be the best that we could do there from the setup that we've been given and the way the option premium works. So let me take a look back into the chat that we've got going here. All right. And I've been messing up here. I've only been looking at the Twitch chat, just taking a look at the YouTube chat that we've got here. Can we take a rundown at what we look at before we take a trade? And I guess your follow-up question was that you've set up the scanner, you've taken 2 trades, both of them were in the money, so you had to do the HT wheel. But let's take a look at what we do as far as scanning. Make it March 22nd for tax purposes. I like the idea. I like where your head's at, Jules. But so this is what we do. Obviously, the scanner, we do have a video on our channel about how we run this scanner. Just scans for things like implied volatility, percent out of the money, to make sure that everything we sell is 100% extrinsic value. Days to expiration, to make sure we're selling the nearest expiry possible, because that's when option premium decays the quickest. Return on risk, since that's pretty much the best general measure of return on an option. And then volume, greater than 20, just to make sure that if this is a trade we want to take on, it's something that other people are actually trading and is a trade that we could potentially be able to take on. So what we do, we just hit scan. It tells you it's going to request a bunch of information. That's not necessarily too intensive on the computer side of things. And this is what it spits out. We sort it by return on risk, because this tells you, the highest potential returns in the market. Again, we're selling premium. We want to see those potential returns. And then we just kind of move down the list. And not everything in here, obviously the big disclaimer we want to give is not everything in here is going to be a good trade idea. For example, EXPR, incredibly risky. That's at the top of the list. I mean, this thing's up to 368. It was at 240 within the previous week. So that's something that could fall back really quickly on you, which makes it a riskier trade. But conversely, when we go into the options chain, we can see that, these things are for weekly puts. These things are offering 20% premium for something that will put you at the basis of $3, which compared to your closing price gives you a 33% cushion in just 4 days on a stock. Now, again, like we mentioned, this is a stock where, we definitely could hit that cushion pretty quickly. And as you could see, if we zoom in after hours here, it did start decreasing pretty rapidly off that peak of 435 that it hit today during the afternoon. But this is kind of a general starting point. We'll just go down the list. We watch the market enough, and I think a lot of the people who follow us do watch the market enough to where a lot of these names are things you're going to be recognizing when you're going through the scanner. We've got Gamestop, got SOS, which has been a really volatile crypto-related company. AMC, obviously, which is hand in hand with some of the GameStop stuff that's been going on. MARA, another Bitcoin-related stock, and that's something, from our risk tolerance perspective, these are a little bit too risky for us, but that's not to say that they can be something that you're bullish on and would like to make a bullish play. And thanks to the returns that these weekly puts are giving us, this is probably one of the better ways to do it. So with that in mind, just going down, reading these, and just going until you find a company that you're bullish on and are comfortable playing. You might say, okay, I think Tilray has fallen back too much. I'd be happy to play that up, and you could get 6% in 4 days with a pretty solid cushion on the 22 strike puts. So that's how we interpret just the results of our scanner. And maybe if we're out of ideas for trades, that's where we look. That's the first place that we start. So going back through the chat, what else we got here? Thoughts on, okay, I guess going back to the original question about both them going in the money and you have to do the HT wheel. If you want to avoid getting assigned the stock, one thing you could do is what's called rolling your puts. And that essentially means, for example, let's say, we could be assigned on AMD. So let's say we were going to be assigned on 75 strike puts. And those are trading for 237. By the end of the week, they'll be trading for about $1. But the idea is that instead of taking assignment at 75, these are trading for $1. We close them for $1, and then we would open one the following week for $3. And I guess we could just even use current day prices. We would close the 75 for about $2.40, open next week, same strike price for $3.30, and you would get about $1 credit there on the difference between the $2.40 up here and the $3.40 on the $3.19 75 strike puts. So that's the idea. If you don't have the capital to take assignment and just want to roll these puts, I think it's a great way to manage a trade, because this $1 credit here that we talked about and the difference between the strike prices, that's a direct reduction of your break-even price on the trade. So let's say you got in at 75 here, which would put your break-even price at about $72.50, since you're getting $2.50 a premium here. If you rolled that for the $1 credit, same strike, you'd have the same max profit scenario. It would just be delayed a week. You would drop your basis or your break-even price from $72.50 to $71.50, and that's a great way to manage trades when you don't want to take assignment. And now we do always say, in the context of our HT wheel strategy, we want to be comfortable with and afford being able to take assignment, because it helps us enter into the second part, which is a little bit unique to the strategy we run, which is the covered strangle. But let's see, got thrown off for a second there, 1 minute. Yeah, so the covered strangle is why we do like to take assignment, but obviously you could roll the puts as long as you like. You could knock it down $1 basis per week just until your puts aspire worthless, and that's kind of the beauty of the option selling strategies that we run. So let's see, next question, thoughts on SUNW 10 strike puts. Let's take a look. Trade at 1093, the first thing we like to do, obviously when we look at the ROR column here for the puts, some great premiums, but if I had to take a guess without having looked at this, this is probably one that's run up a pretty decent amount lately. Zooming out to the, let's do 20-day first. That's surprising. It's come down from 22. You typically see premium like that on something that's spiked up recently, so let's back up a little further, and there's that spike we were, I guess, anticipating that we would see. So one of the biggest things that I think about when I run the strategy is, what is my downside risk on a position? Because really the only way a trade like this can get away from you is if the stock drops so quickly that you're not able to sell enough premium near your cost basis or break-even price, and then you end up having to potentially take a loss. Papa Steve 888, hi HT, how's it going, Steve? Good to see you in the chat. Always love seeing you pop in for these. And back to SUNW, the downside risk here is that we potentially, shout out to Jerry Schmuck for now following, always appreciate that as well. Back to SNW again, the downside risk here is potentially to 52 cents. Now I'm sure there's a lot that's happened in the green energy space, and Alta Fantasia, appreciate that as well, and appreciate you participating in the chat. We always love to have people in the chat, because otherwise sometimes I might run out of stuff to talk about, but we hope that doesn't happen, and we'll keep it rolling here with SUNW. That 52 cents, I mean, is it going to go back to 52 cents? Who's to say? If I knew the answer, I'd be rich, and I would tell you all, and we would all be rich together, and that'd be fantastic. But I think it at least has the potential, since it traded between 52 cents and, I don't know, this $5 level for such a long period of time, that it could potentially come back down to 5. So when we look at what options we would want to sell if we were going to jump in on a trade like this, we really want to have our break-even price in mind and try to get the lowest break-even price possible. So with that in mind, these are monthly options, which does take away a little bit of flexibility, since you can't sell weeklies and adjust your basis week after week. But normally when you do sell monthlies like this, you're able to take pretty significant chunks out of your cost basis each month at a time. So prime candidates here, obviously, are probably your $10 strike put, since that's just out of the money, has a really attractive return on risk, which, I mean, we're 10 days away from expiry on here at 11.42% return on capital risk in a 10-day period of time is something that's really impressive from a risk to reward standpoint. And the $1 of premium essentially would take your base even, or your break even, excuse me, on a 10 strike put down to about $9, which on the chart would be right here. I'm struggling with the mouse right now, bear with me. We'll call this 9, close enough, 904. But the issue with that is, it's still kind of above these peaks that we were seeing a little earlier in the last, and again, this is only a 180-day period. So when things go up quickly like this, they could fall down just as quickly. But again, they could spike back up just as quickly. We don't know which way it's going to go. No one knows which way it's going to go. So the best thing we could do is use our option selling strategies to give us a little bit of cushion when we play it. And if you're bullish on this stock, you like what they have been offering. I think it's solar energy. We could, again, look at our Analyze tab. SUNW. It'll tell us exactly what it is. Sunworks, formerly Solar 3D Inc., provides photovoltaic-based power systems for the residential, commercial, and agricultural markets in California and Nevada. So yeah, solar-related company. That's something personally I'm super bullish on for the long term. I love all of these green energy plays with the way that regulations are potentially moving going forward in the future. I think that's an issue that's going to be brought to the forefront. So again, this is an industry I'm bullish on. Now, whether or not I'm bullish and think that it deserves to keep up what even just at this point is a 20x increase from what it was trading at in September, that remains to be seen a little bit. It's perfectly fair, again, for you to think that it is going to go up. And if you do, maybe even the 7.5 strike puts might give you a little more peace of mind, help you sleep a little bit better at night while still pulling a 3.81% return over the next 10 days, which is perfectly acceptable. 7.5 strike minus 30 cents on the premium you get on those puts would stick you with the 720 cost basis, and that would stick you with the break-even price right around here as opposed to up here. Now, obviously, there is the trade-off of break-even price and return that you're getting, and that's just part of the game that we play. And I don't think there's really a right or a wrong answer. So, in short, if this is a stock that you think long-term is something you would like to be invested in, then you wouldn't even mind taking an assignment at any basis, really, because for today it's trading at 10.93. In worst case scenario, you're getting a basis that's significantly below 10. So, yeah, I mean, especially entry point wise, we love to talk about entry points. It's fallen off a high of $30 down to 10. I sure as hell would have hated to get in up here, but now that you've got the chance to enter at this level, might not be the worst idea in the world. And I think the whole sector in general, there was a one we've been playing, SOL, Renesola, has a really similar chart, and unfortunately it's just been bleeding out a little bit, but we're hoping this is an area where it might find a bit of support. This is one alternatively that has weekly options as opposed to monthly, so you can knock down that break-even price week after week. And honestly, premiums do look a little bit better on this as compared to SUNW. So this might be a better option if you have no preference on company and just want to get into the area of solar energy. So that's kind of my thoughts on SUNW. Maybe SOL might be a better play, but at the end of the day, they both still offer solid premium. Both are in an industry that I think has really solid long-term potential. So they'll both give you break-even prices that are going to be manageable. So neither of those I don't think you can go wrong with, especially with this kind of an entry point. So moving back into the chat, we'll see what we got here. We've got Jules asking about SIG. What do we think right now? I have no idea what I think, so let's take a look at it. SIG, Signet Jewelers. And this is one hell of a run-up. So that would explain why this is a stock that's kind of coming to the forefront of discussion. Let's back up a little bit further. Looks like around COVID, they got down to about $5.60 and have since run up to almost $60. And yeah, appreciate you, Vicente, in the chat. We always love having people throw suggestions. Always happy to look at everything because I think that's super educational for us and hopefully educational and entertaining for you guys. And even a lot of the things that I personally trade are ideas that I've heard from other people. So always happy to have these ideas thrown around and have different things that we could all look at together. So I'm still trying to figure out what's going on with Signet here. If we go back to the 3-year maybe, yeah, it looks like it's starting to run up and filled this big gap from back in 2018. And if we look at where it kind of took that big gap down, it was in that mid-50s level, which is where it returned. Haven't really seen a lot of red candles in the past calendar year. I mean, there's literally, you could almost count them on one hand, the amount of down months or weeks rather that this stock has had. So I think this is one that's primed for a pullback. If I just had to guess, strictly looking at the chart, and again, one of the big indicators we like to use, RSI, it's pretty significantly up in the red area. Last time it even got close to getting above 70 was when it was trading in the 70s, coincidentally, and that was when it had a huge dip downwards. So let's take a look at the news. That's something else we like to look at. And not a huge, Jules, if you know anything about this one, feel free to throw it in the chat and help us out a little bit. But even looking at the chart, looking at the news, it doesn't seem like there's too thick of a news wire on this one. Just talking about how they're on board with $15 minimum wage, how their stock has been running up high to 52-week highs. And I guess here's some interesting from February 19th, that shares of several retail and apparel companies are trading higher amid stimulus comments. But again, I guess just from a RSI and chart analysis, this is one I don't think has too much more room to run in the short term, at least. I think if this is something you're bullish on, it might be a good idea to let it breathe a bit. But nevertheless, we'll keep moving on to the option chain. And then, typically what we like to look at, the first thing that sticks out to me here is there's a pretty decent lack of volume on these options. So even if it was something that you were looking to trade, it doesn't look like there's a whole lot out there for you to be able to find a trading partner to do so, especially on the put side of things. And obviously we really like to get in selling cash secured puts. Okay, so Jules likes the premium, and I think you're right on there with the premium. Looking at the RORs here, even anywhere, these spreads are kind of wide, so these numbers are a little bit wonky, but in general they're pretty accurate. But looking just out of the money, you can get 3.4, 3.3% a week, which would stick you with the basis a couple bucks or a buck below the strike that you sell. So for example, we'll run through an example. Potentially if we did the 55 strike puts for March 12th, this would have about, I don't know, what's the midpoint here? About $1.80 of premium on these, which would stick you with a 53.20 cost basis for just 1 week. Again, if we zoom in to the 20-day, that 53.20 cost basis would be right here. And again, knowing that it's traded, I mean, it was down low 40s back on February 9th, which just about a month ago today. So I think especially with this RSI getting in a little bit dangerous area, we like to talk so much about the trade-off between risk and reward. I mean, it did break through some decent levels. Yeah, it looks like your orders didn't fill today. Definitely not surprising because we look at, we got what, 22, I mean, there's only 22 contracts traded that were just slightly out of the money. So that's super, super low volume. But yeah, this is one I personally would stay away from because, I mean, you could be right if you did like the fact, the way the TA set up, and you liked what was going on with the stock, you like the premium and think it has potential to run. But again, what we like to talk about so much is this downside protection that our strategy affords us. And it looks like this one has a long way down. So personally, that's one I would stay away from. But again, it is one that if you're bullish, perfect to play it with options because they give you such a nice cushion entering from a cash secured put position. So, I mean, not too convincing of a summary from myself or a conclusion from myself right there, but I would just be wary of the downside here combined with one of the biggest indicators we look at in RSI. Next thing in the chat, SFT had good earnings today. Thoughts on if a play now would be chasing? J Marts, shout out to you showing up in the chat again on the stream. SFT, I like that you mentioned if we think it's going to be chasing because it sounds like you know what our answer might be. Shift Technologies. Oh, and this was one that we looked at for one of the newsletters that we previously had. And yeah, thank you, Jules, for the question. Always happy to give the input on the stream here when we got everyone online together. So again, we're looking at the 180-day chart here. What I like here, this is a little bit tighter of a range. Now, obviously, between 6.4 and 15 isn't an incredibly tight range, but for some of these stocks we look at, like when we were just looking at some of those solar companies, things can get a lot wider. Step 2, we're going to go look at the options premium. Volume's a few hundred, which, I mean, obviously not like an AMD or an Apple type volume, which isn't probably what we would be expecting, but at the same time, that's plenty for you to get a couple trades in and get a position initiated. Now, you mentioned that earnings were today. Let's see. Yeah, after hours, they spiked up to 10, back down to 8.4. If we highlight over this, they had minus 7 cents EPS compared to a negative 43 cents estimate. So yeah, solid earnings. I can't really, it's annoying here that they don't show you revenue. They only show you EPS. We could dig into it a little bit, but in the interest of time, I think interesting setup here. As we always know, so much premium is baked into these options before earnings. And then after it, the volatility just completely spikes downwards. And I think we could, even if we backed up to 180, we could show examples of that. But no, it doesn't look like they have earnings that are indicated on the calendar. That's strange, but moving back in and moving along. Whether or not this would be a good idea, I think from an entry point, looking at the 180 day here, 8.4, not a bad place to get in on a company if they had good earnings. I think this is definitely good from an entry point perspective. And whether or not these numbers change, and I think they will change pretty significantly, since it looks like 832 is where it's settled at in the after hours session. And again, we've seen so many different things with earnings. It got up to 10, so there definitely is that little bit of upside, settling at 8.4. I think you're not going to see between 65 and 80 cents a premium for these 7-strike puts, which objectively 10.7% return. That's great, but before IV, I guess, gets crushed in the morning, if it remains up at this elevated level in the mid to low $8 range, I mean, you might be able to get a nice little something above 50-cent fill on this, which wouldn't be the worst thing in the world. Give yourself a 7 cost basis / break-even price on that. But again, it's one of those things where, volatility is crazy during earning events. We're really probably not going to know what the expected premiums are even going to look like until the market opens tomorrow. And again, this was just the after-hour trading session. So much could happen in the pre-market trading session tomorrow that makes all the points we bring up here just completely invalid, like if it runs up to 12 tomorrow morning or something like that. But I do think objectively, if you were able to get in at this level, 832, 835, if it holds that for open tomorrow, and you can get something in the neighborhood of maybe 40 to 50 cents on these 7-strike puts, that's a really, really good value on that. So that's something, just keep my eye on. And these things, obviously, since the volume's a little bit on the lower side, the prices aren't going to update right away. So it's not like you could be right there at 9:30 in the morning trying to get a fill on that, trying to wait for the prices to update. But definitely an interesting one to keep an eye on. And I definitely would give you the go-ahead to let that one rip if you get a premium that looks pretty solid once these settle down a little bit. So moving on next, I think SFT was the most recent, a little bit more of a macro question in the YouTube chat. He's got June 18th, VTI 193 calls that he's been holding down 27%, trying to figure out if I should just close it out or wait for recovery. And for those of you that aren't, I know we've got some people on Twitch, some on YouTube. I'll pull the comments up here really quickly just so you could read that. I know sometimes if I'm putting you to sleep, you might have missed the question real quick, but that's it right there. He's got VTI calls, 618, 193 strike, and down a good chunk, which, it happens in a pullback and things like that. So we'll pull that back off the screen and take a look at VTI. And that's the Vanguard Total Index Stock ETF. Long term, this is something just to get off the whole option trading. J Mart's giving a shout out to Twitch gang. I love it. But to get off the whole option trading and selling tangents that we normally go off in here, this is something that I love having long term. I hold a lot of this in my retirement account. I do have a decent investment horizon for that. So I personally think anyone who's maybe under 40 years old even should be mostly into stocks, because this is just a broader discussion, kind of irrelevant to what we're going through here really quickly. But even the COVID crash, as we all know, has been resolved relatively quickly. And most market crashes in the last, 15 to 20 years, the dot-com crash, the financial crisis in 2008, were all recovered relatively quickly. So as long as you're anywhere where you're, I think, over 10 years away from potential retirement, something like this in the long term from the returns you're getting is almost a no-brainer. So I've got a lot of my retirement accounts wrapped up in total stock market ETFs just like this one. So a little bit of a tangent there, back to our regularly scheduled programming with some options trading. So he's got 618 VTI 193 strike calls. If we pop open that June option series, we could minimize these really quickly. 193 are trading for 1290. We'll call that 1330 at the midpoint. So we know that with the, let me get the calculator on screen here so you guys can see what I'm doing. We know that with the 193 strike and what we'll call, let's see, 1330 at the midpoint, 1325 might be a little more correct. I'm Ignore my mental math. 193, we'll call it 13.25. So your break-even price on this is $206.25. And it's got to get there by June just for you to break even on that, which is 625 increase from here. 0.25 divided by 199.77 is a roughly 3.14 increase over the next, what's March right now, over the next 3 months. Good Lord, years moving quickly, but that 3% over the next 3 months, total stock, I guess we could use SPY as an example. That averages about 10% a year. So, I mean, 3% gain in the next 3 months isn't out of the question. But I think the better question, as you did mention here, is kind of a little bit more of a macro question. What are we looking at in the market upcoming here? And this is, again, something where I've been a little bit wary of the action we've seen in the market because, I mean, things aren't great in the economy. Obviously, they're coming back. We've had some Fed policies that have greatly aided that. There's a stimulus coming through. Whether or not that's going to contribute too much to the inflation or things like that kind of remains to be seen. I don't think it's as big of an issue as some people make it out to be. But biggest question, and that the question that was asked to stop myself from getting off track again, is are those 193 calls going to see a profit, or should he close them out now? And I really think it's tough to say without knowing what's going on in your overall portfolio. I think it's okay to always have a bullish play on something like this because in the long run, the market goes up. That's just how it works, which is why our strategies are inherently bullish in the long term. So, I mean, not the worst idea to have in your portfolio, but if a significant chunk of your portfolio is invested in a long call that is dependent upon this getting back up 3% in the next 3 months after the market's already gone up a ton, that might be a little bit ambitious based if that position sizing is significant. So, I mean, in conclusion here, maybe I think it's got a decent shot at least breaking even. But I know when you're using calls that are a few months out, slightly in the money, you're trying to do a little bit better than break even, and you have to get up to this area. So I'd probably personally would close out and maybe move into something either longer term if you were going to continue to buy options. But as we always like to talk about here, we love to sell options. So potentially would, if you could and do have the capital, maybe something like a put credit spread would be a good bullish way to play a larger name like this. Or if you could potentially afford the margin or maintenance requirements to sell puts, I think that's another great way to play something like this one. But yeah, that's kind of my 2 cents on that. I do always think, and as I've mentioned a bunch over the course of this broadcast, is that we exclusively use option selling strategies. So anytime I see an option buying strategy, I'm a little bit wary. But I guess to almost evaluate the position, one good thing is you're in the money, so there's not a ton of extrinsic value on this. But at the moment, the intrinsic value on this $13 premium is roughly 7 cents, meaning half of it is extrinsic. Again, meaning if nothing happens in the market and we stay totally flat till June, you're going to lose another half of the value on that. So that's always a value proposition I try to stay away from myself, and I'm a little bit wary of when the discussion of option buying comes up. So personally, not a huge fan of it. If it were me and I were in your shoes, I would close the position out and move to something that gives you a little bit more time, such as option selling, or even just grabbing a leap that's deep in the money so you could still be capital efficient while decreasing the effect of extrinsic value against you. Or again, like previously mentioned, jumping into something like selling a put credit spread, which is also capital efficient and puts the effects of theta decay, and I guess IV crush isn't as big of a deal on a total stock market ETF, but theta decay for sure will be swung to your advantage as opposed to having it work against you over the life of the trade for that extrinsic portion of the option premium. So that's kind of my 2 cents on that one. And then next question, another one from Vicente. We've got, is it too late to get in on XOM? I think that's ExxonMobil. It is. Another really strange chart. We've got the 3-year up. Let's go to the 180 for a little bit shorter term. Yeah, I think first impression here, I definitely think it is a little bit too late to jump in here. Not only because, last October it was at 31 a share and it's doubled in 5 months. these are some of the trends that we look at across the market and say, okay, we might need to pump the brakes on the little rally that we've had because, does it make sense for a company as big as ExxonMobil to double in value over the last, 4 or 5 months? And typically we find ourselves saying that the answer to that is no. But I guess we could back up a little bit further, even to the 1 year. Because, they got down to 30 at the peak of the COVID crash, hit 30 again in October, and just have suddenly recovered. That's a little bit, I guess I could say, fishy, but there is somewhat of a gap at this level to fill up to 70. But again, what's the risk reward trade-off of you trying to get this gap fill up to 70 to try to get $10 back, as opposed to the potential downside back into this $40 range, which is, I think personally, outweighs the upside. But again, going back through our process, we'll look at the options. They're offering weekly series, offering between 1% and 2% a week, just out of the money. Not too bad, especially for a company. I guess a company I was about to say as stable as Exxon, but as we could see over the past 180 days, it's been running. And again, back to the RSI indicator, I think this is definitely something I would wait to cool off if you are interested long term. Again, I always like to tell people it's okay if you have a different opinion on a stock than me, but I do think it's important that we try to play our opinions in the smartest fashion possible, and through that is where our option selling strategies come into play. So personally, based off what we see here, the amount of premium it gets you, you're only getting a buck of premium right at the money, basically, and that I don't think is enough to combat any potential drop that we could see from this one in the near future. So keep an eye on that RSI. Potentially, even if we zoom into like the 20-day, the RSI is, a little more reasonable. But I think overall that bigger trend that we look at when we zoom out on the chart is what we're a little more concerned about. And that's what would tell me to give you the advice to just, hang tight a minute, potentially wait for it to drop back down to the mid 50s. I think we could definitely see something around 50s in the future. And getting back to the conversation that came up when we talked about, the future industries that we think are going to do well, when we were talking about solar and green energy, ExxonMobil is kind of the other side of that coin where, energy, for the things that they offer, I'm sure will be around for a decent amount of time, but it is something that I think is trending in the direction of being phased out of, our consumption and the lifestyles that we live. So always important to be, have these longer macro trends in mind when you're investing. Now, I know a lot of our plays are short term, but if you've got something like this, you think it's going to go up a little bit, but we do have this downside risk and a potential macro trend in the market that would push it downward, that's where I'd be a little bit concerned and potentially stay away. So next one, hey, on PSTH, can you give an outlook and plan on that going forward? Really happy to answer that. That's from Typical Tangerine 26 in the Twitch chat. Appreciate that input. Hopefully you're still on for this and I haven't scared you or bored you off with the little spiels I've been on so far, but we'll take a crack at PSTH. Again, this is one we personally are holding a few hundred, I think 400 shares right now. We've got covered calls sold. Something that's great about this one is previously it was one that only had monthlies, and then the amount of interest in the stock and the option activity has given us weekly option. Did I say that backwards? Previously had monthlies, now has weeklies. I don't think that's what I said, but that's what I mean. Previously had monthlies, now has weeklies. Good Lord, I can barely talk. But rolling right along, traded 26.15, back up to 27 after hours. So, not too bad of a place. And again, talking entry-wise, this is a really, really good level on a SPAC. When we back up, it has a net asset value in the low 20s here. So your downside is severely limited. And if we go take a look at the life cycle of a SPAC, we could just use this chart as a starting point. You've got net asset value, trades pretty flat. Around the end of 2020, SPACs started getting a little bit more buzz. So you start seeing price inflation, you see rumors, and every now and then you'll have a spike, but you really don't see that one big spike until the announcement of a target company, and that's when stocks just fly. And we could use one of the social media's darlings, CCIV, as an example of that, where we see, traded around 9.6 for the longest time, had some rumors they're merging with Lucid, and then it just completely runs up, and then you have the actual merger itself, and you see a sell-off, which is why for these, we've kind of altered our strategy. We don't really want to be holding on to these until we want to be holding on until we get a target announced, but after that, we want to be out before the merger. And I don't think we're the only ones who are thinking that way. So maybe in the future going forward with these SPACs, we might see the sell-off a little bit further in advance of the merger. But, that kind of remains to be seen. We'll just trade the market as we see it presented to us. So jumping back into the Psth chart, entry-wise, great level to get out here, 26.15, where you could sell weekly puts really for multiple percent premiums. I mean, the premiums on these are awesome for the lack of perceived downside risk with a net asset value around the low 20s. I mean, you could have a 6.3% return at 27, or you could have the stock assigned to you with the basis right around 25.50, which going forward, you could sell another weekly call for another $1 and be below a $25 basis in, less than 5 days from now, which is an awesome value proposition. And then the only thing that I think bears consideration when we talk about our strategy in the context of what we're looking at here with Psth and the SPAC is the fact that our strategy does cap upside a little bit. So if you're selling cash secured puts, if you sell a 27 put and Psth spikes to, they announce a good target and they spike up to 40 tomorrow, you're only going to get 6.3%. Now, our mindset with that kind of a thing is, if you're getting 6.3% in a week, that's one hell of a return, and we're going to keep doing that as much as we need to and just ignore the FOMO of seeing some stock run away from us because we've been on the wrong side of it and seen the downside so many times that we're perfectly happy, relatively capping our upside. But when you get 6.3% a week, I can't emphasize enough just how huge of a number that is. So there really is no need to feel left out or worried that you might be missing something in that regard. But that brings me back to the point of the potential when we talk about the SPAC the SPAC timeline life cycle, and the fact that I do think we're going to see a good target and a decent spike, at least back above 30 at some point in the near future. So you might not want to cap yourself at 27. So what's the best way to utilize our strategies and I guess play that thesis? And that would be jumping directly into covered calls. So the play here is, you'd purchase shares at 26.15, and then you'd sell maybe a 30 strike call for the week for, you get a little over 35 cents for that one. And that would mean your break-even price now is 26.15 minus 30, which would put you at 25.85. Again, check me on the mental math on that one. Think that one's good to go, though. 25.85 is what your basis would be after 1 week. And then, if it spikes up, you get to sell your shares at 30, which is over a $4 gain per share in just one short week. And again, we know how the cycle goes. If you've been following us, if it doesn't hit 30, you just sell another next week for probably over 50 cents. I don't know how much premium these are going to hold in the next 4 days, but your basis is now getting down near 25. And, point being, you'll see how this kind of plays out week after week. If you're knocking 50 cents off your basis, you start here, you're here, then next week you're there. After that, after a month or two, you're down here, which is below the net asset value of the SPAC, meaning you're below pretty much the lowest that this can go in the short term. So that's why we love these option selling plays when speculation creates premium like this for us. And this might be one where we do think it could be smarter to jump right into covered calls as opposed to cash secured puts. And like you mentioned in the chat, you've got 29 covered calls. I think that's dead on what we've got right now. We sold the 29 covered calls this morning, I think, because we were busy on Friday and forgot to recover those shares. But if you're thinking about running another cash secured put, that gets into the covered strangle strategy that we like to talk about. And I think this one is phenomenal for a cash secured put. And I guess instead of maybe buying 100 more shares and doing more covered calls, using that cash secured put, as you potentially suggested, is an awesome way to expand your position on here, because not only would you have shares, now you're already in on it, so I'm not sure what your basis is, but using this 26.15 basis example going forward from today, we'd buy 100 shares at 26.15, and I'll pull the calculator back up, 26.15, we'd sell 30 strike calls for 35, which takes 35 cents, off our basis, which gets us to 25.8. And then the best part about the covered strangle, and which means that you're selling another cash secured put. So your full position is 100 shares, one covered call, and then one cash secured put. So the best part about that is you get double the reduction of your cost basis, basically. So if you wanted to sell a 26 strike put, which is out of the money, so entirely extrinsic, you'd get $1 premium on that, meaning if it's not assigned, you get another $1 off your premium. And all of a sudden, on a stock that's 26.15 today on March 8th, by the end of the week, which is, let me check the calendar real quick, March 12th, your basis is going to be 24.80 in just 4 short days, which puts you here. And the last time this thing traded at 24.80, I mean, you got to go back to the end of November. And then guess what? Next week, you could do the same exact thing and knock another $1, $2 off that basis and get yourself into net asset value territory with that cost basis. And I mean, and if there's no announcement by then, that's when you could really start getting aggressive and say, okay, I'm going to start selling, 35 strike calls because, hell, my basis is already down here. I might as well make a potential home run play for myself. So that's kind of the mindset moving week to week on this one. And I'm glad you brought this up because this is one that we've got, and just such a great combination of where this is trading in relation to the net asset value, and combine that with the option premium that we see on both sides of the coin here, the calls and the puts. And, to top it all off, you've got a guy like Bill Ackman here. So much of the criticism surrounding SPACs is the fact that, their incentives aren't necessarily aligned with those who are buying the SPAC. A lot of the times the people who are running the SPAC, all they really care about is just getting a deal struck with the company, period, so they could get their incentive-related payouts from that, as opposed to taking time and bringing a solid private company public. And this is where I think investing in something like this gives you a little bit of an advantage, because you've got a guy like Bill Ackman who's not going to just half-ass throw some terrible private company into the public markets. He's mentioned several times that he's looking for, I guess, what you could call a unicorn investment. So I think we could count on him, at least in the near term, to deliver a name that'll drive up enough excitement to get us testing this $30 level again in the short term. And even if the announcement does kind of drag along, we are perfectly happy to run cash secured puts, covered calls, covered strangles to knock our basis down around net asset value in the meantime. So that is PSTH and our thoughts on that going forward as we head into March. So next one, looking from the YouTube chat from Young Hat 5, we've got Do IIPR. IIPR. Innovative Industrial Properties. Interesting. So this is one, typically a lot of these that we talk about on the stream are things that are super popular across social media, because those are the ones that are getting a lot of buzz. People love to hear about them. This is one, I've got to be honest, I don't think I've heard of yet. And from a chart, at least, looks like a lot more responsible of an investment than some of these meme stocks that people like to talk about. So first thing we do, obviously, when we're on Thinkorswim, to walk you guys through the process again, we don't know what the company is. We're going to hit analyze. We're going to go IIPR, and it's going to tell us exactly what the company is. And they are a real estate investment trust, so they're a REIT. And for those of you that don't know, a real estate investment trust is essentially a holding company that just owns a bunch of real estate across different areas, regions, industries, certifications of buildings, and they derive their returns from that. They typically pay pretty good dividends, have more steady share prices in general than other stocks, and I guess really a lot of it has to do with how you feel about the real estate market, but I think they're a really interesting thing to have in your portfolio and a really reliable long-term investment, as opposed to some of the crazier stuff that we like to play in here. But getting back to the company description here, it says they're focused on the acquisition, ownership, and management of specialized industrial properties leased to state licensed operators for their regulated state licensed cannabis facilities. That is a little bit of a twist. So it acquires properties through sale leaseback transactions, third-party purchases, blah, 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 blah. They own 67 properties located in 17 states, totaling approximately 5.7 million in rentable square feet, which again relates to, as it's set up here, cannabis facilities. And I'm assuming, they're based out of Park City, Utah. Hell of a place for a cannabis company to be. But I think the fact that, this is an interesting area and there's going to be a lot of demand for it, and we like to talk about these macro trends where we're moving in the market going forward. This is one, cannabis, that I'm also super bullish on, because, legalization is kind of dragging its feet a little bit, but it's one of those things that's going to get here eventually, whether, personally, if you like that or not. Triple net lease, cannabis, and replay. From what I'm reading from the description here, I really like the business that they're in. I think there's a ton of room for growth in that area, and based off, I mean, it was super high level, that description we read, but it sounds like the way their business is structured would have them set up to help potentially meet a lot of this demand for when a lot of players are going to be trying to get into the cannabis market as it becomes legalized. So if they're an established name and kind of the go-to company for someone who is looking to rent that type of space to run that sort of an operation, this could be a good name. Even better that we like to see is the fact, obviously we don't like to see that it's, gone down ever, because we would love for our stocks to go up forever. But as far as entry points are concerned, this looks like as good of a point as any. I've been talking about the RSI all night, and it's dipped back below into 30 in that little blue range is what it highlights it as when it gets that low. But I mean, historically, looking at how RSI has been as an indicator, when was the last time it was blue? It was February 25th, and you can see that was right after this red candle, and it spiked all the way. So the red candle is from 207 to 174, obviously pretty gnarly red candle. But when the RSI finally got to the bottom, it went back from 175 to 204. We look at the last time the RSI got into the blue before that, it ran from, 109 up to the peak here before it steadied out at 158. So a 50% runoff that other time that it got blue. And then going back to June, there was another time it dipped into the blue over here, where it ran up subsequently from 84 up, and it looks like it almost touched 100, just below it. Regardless, point being, this is a really good entry on this for what I think is an interesting company. Appreciate you bringing this up in the chat, because I think this is an area that is, let's see, RSI looking oversold, but do look at the MACD as well. Exactly, that's also another great indicator to look at, and I'd throw it up here if I wasn't just having a ton of different accompanying charts under. But we do love an oversold RSI for when we're trying to get in. This fits the bill. I think if we look at support and resistance, it may have broken a little bit of an area of support at 170 here. I think there's going to be a cushion to catch it at 150, in the mid 150s for sure. But it's also one of those things, like if we know the upside here is that it potentially gets back up testing all-time highs at 222, which is what, $60 away. Are we worried about $10 more of upside in the or downside rather in the short term? And I think the answer to that is a resounding no. So I think this is an awesome entry on the stock here. Take a look at the options. Again, not terribly liquid, but the premium itself is absolutely there. It closed at 165. If these spreads are pretty wide, so it's important when you're trading something like this with such a wide spread that you put a good limit price in, because sometimes these big spreads work against us, but when you put a good limit price in, sometimes the person on the other side of your trade is the one who gets a little bit screwed over, and you could get a really solid fill price. And again, March 19th, just 10 days away from tomorrow. So I guess, shut up, that makes 11 days from today. Duh. But the 165 at the money give you a 4.43% return. Even the 160s, which midpoint roughly, mid fours, gives you a 3% return, and that would put your basis down at 155, and voila, that's exactly in this area right here. So I think entry-wise, this is one I think would be awesome to sell some, 160 strike puts at for March. If you get assigned, happily take assignment of shares with the basis right around here with this kind of upside looming. But even if you just wanted to jump straight into shares and sell some sort of covered call at a 185, which would lock in a pretty solid 10-day return. But let's see, it says you'll make another long-term entry on this one, actually in the long term on 500 shares at 55. Okay. I mean, you're killing it on this one if you got in at 55. Jealous of that entry. But, I mean, yeah, if you're just planning on long-term holding, you're good to go. If you want to enter more, I think cash-secured puts are going to be the way to do that if you plan on picking up a couple hundred other shares, because especially if you're looking at yourself and you have this position where you already have a position, you could either happily collect the 160 premium, or you'll add even more to that position at a much better price than what's happening at 165 today. And, if you get a bad deal on these puts where you sell 160 strike puts and it runs up to 200, like, okay, we'll happily collect max profit. It sucks to have your gains capped on the puts you sell, but meanwhile, you're sitting pretty with 500 shares of stock on something that's run up to 200. So it's kind of a win-win situation here if you did want to use those cash secured puts to potentially increase that long-term position. So J Mart's back in the chat. I think this will be the last one we cover. We're getting to the back end of an hour on the stream. So I definitely appreciate everyone who's tuned in and made suggestions. We'll try to do this a couple times a week and always happy to run through because, things happen in the market. Every day we could probably talk about something new with what's been going on lately with the amount of volatility that we've seen, but always happy to hop on the stream with everyone and do our analysis together. So it helps us with our trade ideas, and we can help you guys out with yours and help you guys, I guess, see what we do when we evaluate trades. So MAC is the last one we're going to take a look at from J Marts again. I don't even know if I'm going to try to Macerich. Yeah, okay. We'll call it Macerich. Hopefully I pronounced that right. MAC again. Same deal, self-administered and self-managed real estate investment trust located. They're focused on the acquisition, ownership, development, blah, 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 and leasing of regional shopping centers located throughout the United States. So this is one where, you could consider real estate itself an industry as opposed to different industries like tech, energy, things like that. Real estate would be its own separate umbrella, but obviously within real estate, there are these other umbrellas and classifications of properties. You got things like apartments, you have retail, you have residential, you have healthcare, you've got, hotels, all sorts of other smaller subcategories in real estate that all have performance that varies pretty wildly. So this one, as we've mentioned, is a leasing of regional shopping centers, so retail. And that's something obviously is going to be hit harder than most because of COVID, as a lot of these in different states are closing down. Now, looking at the 180-day chart, I think it might be a little more appropriate to back up one here and see the COVID effects on this one. So yeah, we've got a base of 481 at the very, very worst of the COVID crash for this one, and then got it to really unusual to see a move like this. Let me back up a little further. Okay, yeah, previously trading way, way higher here at 60.95. So if you're looking for upside, it's definitely there. We can't really do a deep dive into the financials right now, but it would be interesting to see, what's caused such a big decrease. Even before the COVID crash, it had run down to the mid-20s. So I don't know if we were already seeing some different. Okay, we got one more request in the YouTube chat for UWMC analysis. I'll stand corrected. We'll do that, and then we'll sign off for the night because I think UWMC is one we've been pretty heavy on and are always happy to talk about what we're looking at going forward with that one. But back to MAC real quick. We've got this big downward trend. I don't know too much about the real estate, specifically the retail trends lately. I imagine things are probably projecting to look upwards as things reopen, and that might be what a lot of this recent stock activity that we're seeing. But what I do find interesting, okay, Gamestop as well. We'll cover those last two because I think I did put Gamestop in the stream title. So I think it'd be false advertising if we didn't cover that one. So wrapping up on MAC here. What's interesting, this is typically what you will see in a REIT. There can be some of the most boring stocks out there as they just bounce up and down, up and up and down, up and down, and then trade or give out dividends every quarter, which this one doesn't look too bad. 15-cent dividend, 15-cent dividend. Another thing to remember in the context of our strategy is that when dividends are paid out, it's a direct reduction of the cost basis. So anything that you get dividend-wise, you could add that to the put premium or call premium that you're selling when you're calculating your break-even price or adjusted basis on the stock. And that would maybe be a good segue into the UWMC conversation, but I do want to potentially look into what happened at the end of January here because like we mentioned, this is typically what you'll see when you look at the way that a REIT trades. Every now and then you could have a spike if something happens, so this isn't anything out of the ordinary, but I do think it's incredibly strange to see something where they went from 12 up to 26 and then pretty much right back down. So let's take a look at the news wire going back to January if we could see anything. On 12th, it looks like this happened. This first happened around the 25th of January. Macerich scheduled fourth quarter earnings release and conference call. That's not going to be it. Looks like they had a maintains underweight, so not even a good rating from Morgan Stanley here. Okay, looks like there was a lot of short interest on this one, and it kind of got grouped into the old short squeezes that were going on at the end of January, which coincidentally go to the end of January. Speaking of short squeezes, there's the segue we were looking for. Gamestop right in the same window. So funny enough, the stock that we were going to talk about as we start to wrap up this video, we'll get to UWMC after this, but GameStop, the short squeeze itself probably powered the squeeze we saw right here on this stock. So there we go. Interconnected right there as we move right along. But, back to MAC really, really quickly. Again, 4.42% weekly return on options that are decently out of the money, giving you a 1250 basis, 4.42% return in 10 days. I really like that value proposition on something that hasn't traded below 1240 in just over a month. So I think that's definitely a good one to potentially jump in on with cash secured puts, and then moving forward, potentially these monthly covered calls to knock your basis down further and collect that dividend as they pay it out. So now we will actually get into GameStop, which again, we all know the story that's been going on with this one over the past 180 days. Bottomed out at 377 as they were staring bankruptcy in the eye due to the way that their business was trending. COVID obviously didn't help with their brick and mortar type operation. Take a sip of water really quickly. Okay. But again, end of January, I think everyone who's been following the market, hell, I'm sure you guys have had similar experiences. People you don't know who are following the market are talking to you about GameStop. So I think almost everyone on earth is aware of what's been going on with this one. So we'll zoom in on that first short squeeze. Obviously peaked up around 513. And what this could be interesting for is, to set a little bit of precedent and give us an idea of what numbers we could possibly see going forward from here. So if something does get up to this 500 level again, the fact that precedent's there and there's this little bit of a gap to fill back up to that level. And aside from that, the fact that, these big round numbers can be psychological numbers in a sense for traders. Your dad asked you about GameStop. I have so many people in my life are, you getting in on a GameStop? And I'm like, no, sorry. But, it doesn't mean it's a bad idea for those who do, as you can see, because everyone who got in here and got out here, it made me look like an idiot for that few weeks, and definitely would have been lucky to have that. But at the same time, looking at, what we could expect going forward, we did make a little bit of a video with GameStop analysis talking briefly about this, but if this breaks through what looks like is decent resistance at 200 based off what happened back on the 24th of February when it first had this second spike upwards. And I will say what's interesting about this move is when you see short squeezes like this, it's a huge green candle, huge green candle, huge green candle, and then inevitably it's going to fall back down. We did have a little bit of that here, big green candle, big red candle, but between February 26th and obviously today, March 8th, it's been a steady grind upwards until we saw another big 41% move today on the stock. So that's something that we think has been pretty interesting, because with these short squeezes, it's normally a super volatile move up and then down, and this would suggest to me that, it's forming a little bit of a base and is potentially ready to move back up, start pushing 300, 400, 500. With the mechanics of how short squeezes like this work, you never really know how something like that can go. And one thing that, funny enough, a website that we talked about in our video is thesqueezesquoze.com, and we'll throw this onto the screen that we are streaming right now. It says, as of Monday, March 8th, the squeeze has not been squoze. And what this does at a high level, this website gives you, a few different metrics that primarily make up the mechanics of a short squeeze. So short interest right now, 14 million via S3. That's 25.4% of the float, decently high number. Borrow rate, when you short shares, you're borrowing those shares to short, so you have to pay money, interest on those shares. And that's what the borrow rate refers to. 1.65 isn't terribly huge of a percentage. And let's see. And it does sum up a little bit of the news here for us. And it says the price spiked today on GameStop's announcement of an e-commerce transition committee in conjunction with gradually declining short interest. And shorts are exiting their positions, but nobody's being forced to buy back their short at any price. Now, I will say that does seem a little bit interesting, because that almost seems contradictory to the idea that there's going to be a short squeeze. So if, shorts are exiting their positions, the likelihood we see something like this decreases. But at the same time, if people are loading up for the long term at this level, we might see a little bit more of a price base. So I guess two of the things I talked about in my video are personally, now you could think whatever you want to think about GameStop, and I won't tell you you're correct or incorrect, but the conclusion we came to is that something like this is pretty unlikely to happen again, because like we see from the website here, Short interest is declining. These numbers aren't nearly as severe as they were for the initial short squeeze. But at the same time, I think there could be, like we saw with Robinhood and a lot of these brokers, when something like this happens, the systems that they have in place can't physically keep up with that and handle that amount of demand and the amount of cash that's flowing through in these transactions. So you saw what happened. I mean, the retail investor gets kind of screwed over. They're not able to get out of their positions or witness what I think was legitimately set up to be one of the biggest squeezes in the market, just because, something completely out of your control comes up when the brokers say, okay, no more trading. We can't fulfill our obligation, which is, quite frankly, ridiculous. And as an example of where maybe some brokers need to have regulations put in place on their end to prevent something like this in the future from happening, where retail traders were, for all intents and purposes, retail traders were correct. They got the squeeze, and I think it would have gone much higher had, the bigger entities in the space not stepped in. They did, like you said, they broke the game, yeah. But that's probably reason number one. I think we probably won't see something like this again, is because we could be dead on with the thesis. GameStop could have some good news. Shorts could start covering their positions, but we can get to another position where, a brokerage is just pull the plug, and it's like, okay, well, what's the use in being correct when something like that is completely out of your hands? And then the other thing we talked about is the fact that one thing needed for short squeezes is a small amount of shares. And one thing GameStop could do, because objectively we did get into the whole financial statement analysis side of things in the video that we made, and we've got that up on our YouTube channel if you want to take a look at that a little further. I won't get into that side of it too much, but I think it's a very real possibility that GameStop issues additional shares and dilutes their open shares that they have trading on the market, which would subsequently tank the value of the stock and take away the potential for the short squeeze. And I think that's something, from their perspective, like, to be completely honest, unfortunately, the way it works is they don't care about the retail investor. They're trying to do what's best for their business. And I think anyone with eyes can see that this is pretty overvalued right now. And if I had to bet at every dollar I own, I think it'll be below 100 and maybe back to this level probably within the year, pretty soon. But I think they'd be dumb not to take advantage of this increased valuation, issue more shares, dilute the stock, which would give them funding they need to continue their business operations and accomplish their job, which is to ensure the success of the business, as opposed to artificially keeping the price of the stock propped up. But, since we did see this upward grind, we're getting back at this 200 level. I think this is going to be a really important area of support or resistance, rather, to see if it breaks higher. Now, it did break 210 for a minute, and we saw how strong that resistance was, as it almost immediately got knocked back down to 170 and then grinded back up there. But if we do see another big candle, where could we get back up to? That's tough to say. I think we could see it pushing 300 if it gets past 200. But again, this is one of those things where I would really only be considering this from an exit strategy perspective if you were someone who's already holding GameStop, because we like to look at risk versus reward. We know for a fact in the future, GameStop is going to be below $200. That's just how this thing works. One of the other short squeezes that I remember in recent memory is Tilray. Something similar happened, not this one, but if we back even further up 3 years ago, this thing got up to $300 and just grinded down afterwards. There are obviously little dead cat bounces, spikes along the way, back up to 100 from 70, but in the long run, it's going to go back down. And it went all the way back down to 243 before, kind of doing this thing all over again. A little bit of deja vu for those who have been involved with that stock for a few years. But long story short, we know that GameStop is probably going to go back down below 100 even, which would represent a 50% loss from where you're getting in up here. Is that worth the potential 100% gain if we see 400, which again, we think is even more unlikely this time around? Again, that part is up to you. But those are kind of our thoughts on that. I don't think the trade-off between risk and reward at this 200 level is worth it. I would just hang tight, and if this is something you do want to keep playing long term, you'll be able to get a better price at some point in the future. So let's see. We're going to take a look at very last one of the night is going to be UWMC. And that's one obviously we've been pretty heavy on. We made a video about that, about why we thought it was the single best value in the market when it was trading at 990. So obviously we feel even stronger about that now that it's trading down at 822. So I think we made that video right around here. Obviously not the greatest look in the world for when something like that almost immediately goes down to 7. But we're still incredibly bullish on this stock long term from a fundamental perspective. They've had some really strong earnings. A lot of people compared them to Rocket Mortgage, which is the reason for this spike up here to 12 when we thought we were going to be able to hit max profit in all the many positions that we were currently holding on that one. But that quickly fizzled out. But, our break even is right around this price, which is not too bad for something that has pretty much moved, 20-30% against us. And then in April, thanks to the short squeeze basically that we had a couple days ago, there's still decent premium in these calls, so we can knock our cost basis down another $1 in a couple weeks. So that's something where this is such a great, as we've talked about in our videos, a great combination of option premium, value behind a company, and entry point from a price point perspective. So you spent about 300. Let's see, we made a killing on that. Spent about 300 on 10 strike calls. Let me bring this over just so I'm not just reading off some random stuff for those who are watching on Twitch. It says Young Hat over on YouTube made a killing on that. He spent about 300 on 10 strike calls. Sold as soon as the market opened, as it was falling. I mean, hell, if you have the discipline to get in and get out like that, that's awesome. Hell of a time to do it after it popped like that. But as far as the context of our strategy, what we've been doing, for those who've watched our videos, we're just knocking that basis down week after week. And in the example video that we give, which unfortunately we quickly had to release a how to manage a losing trade video after we released the initial video, the basis that we have in that coverage Strangle is right around this area as well. And we'll be able to further lower that another $1 or so going into April, 10 days from now, when we can readjust these positions when the March 19th series expires. So really long term, not one we're worried about even remotely, because we can get $1 off the 7.5, $1 off the 9 calls to reduce our basis pretty much 2 full dollars from that premium, which would take our basis down to like the $6 level in less than or just over a month, I think, which on a stock like this, we mentioned again, super strong fundamentals. They're making tons of income, taking out a good amount of cash and actually converting that cash into revenue and subsequently profit. Their net income has exploded. I think it's in the billions now after they were kind of teetering along the general baseline of breaking even. So that's something that we're super bullish on. And in times like these when the market's a little bit shaky, I think it's super, super important to invest in companies with those strong fundamentals, because when things get knocked down, all these growth companies, things like NNDM is an example, not to pick on any if we have NNDM shareholders in here, but it jumps up a bunch and it gets knocked down super hard when the market pulls back. I mean, the market pulled back a bit and this thing had a 50% haircut off the share price at the peak. And JMar's, I think that UMC 20 covered call is, I mean, do you saw that for March? That thing's got to be almost out of premium at this point. Yeah, you've got 7 cents left on that. I'd even think about rolling that down to 10 in the near term, or even 9 to collect 30, 40 more cents of premium. And then if you have a jump up to 10 in the next 10 days, that's a 25% return on that associated stock over the next 10 days, which I would take that in a heartbeat. But, moral of the story, what we've been kind of reiterating the entire time with this trade in the videos where we talked about it and how this all sets up for us. Yes, subjectively, it sucks when a stock moves against us. We would always love to sell cash secured puts and hit max profit every week, but the reality of trading, that just doesn't happen. So a move like this where it's gone 20, 25% against us is a little bit intense of a move, but thanks to the premium from the opportunity that we identified, we've got a huge cushion. And in 10 days or so, should be able to get this break even down here for April. And we hope that based off the good fundamentals, another thing we want to talk about is the dividend. Tomorrow is the ex-div date, meaning that all people who own the stock on that day are going to get a 10-cent dividend, which is another, again, 10-cent reduction in our cost basis or break-even price. So that's something that's positive for the future. They're going to pay that quarterly. So even if, shit keeps hitting the fan here and it keeps dropping as we move forward through the year, every 3 months, we're going to be getting another 10-cent reduction for 40-cent reduction over the course of the year. And when you combine that with the amount of incredible premium these are offering, I mean, if it never gets back up to the 10 level, this is something I could see being something we get down to the $0 basis club by the end of the year, where we're able to knock it down $1 a month at a time. And by New Year's, our cost basis is like negative. And that's something we've had happen a couple times. We've seen some people in our Discord server who have accomplished that. And like J March just pointed out in the chat, we've got index inclusion March 21st. And that's actually an interesting little wrinkle. So I'll talk a bit about how I plan to manage that. So March 19th, I think can we move the, no, I can't scroll left or right. I probably can. I'm just too dumb to know how to do it. But March 19th falls right around here. What's happening is they're going to be included in the Russell 1000 and 3000 index, I believe, on March 21st. You might be thinking, okay, whatever the hell that means. Point being is that there are a lot of index funds out there that track the Russell 1000 and 3000 indices. And on March 21st, they're going to be required to buy a bunch of shares of UWMC. So what we're going to be seeing is probably something called index buying, which is where those ETFs that track the Russell buy a bunch of shares so that they could now effectively track the Russell with UWMC included. And that typically involves a decent little spike in the stock price. So typically with our strategies on March 19th, we would want to roll these to April immediately. I'm actually going to do something probably counterintuitive to that. And I won't be rolling my calls over right away. I'll roll the puts because I'm, always bullish on this. Always want to collect as much extrinsic value on those puts that we've sold as we can. But I'm going to hold off on calls because we've seen the potential for this thing to pop back up to 10. If a bunch of index funds are going to be buying it, I think we could potentially see a decent spike around March 21st, at which point I would then get into the April calls, which I could hopefully sell for a little more premium. Get over $1 for something that's above 10 would be a phenomenal deal to lower that break even further. But it's one of those things where if we have the thesis that this index buying is going to happen, even if it doesn't happen and we're wrong, March 21st is a couple days after expiry here. That Monday or Tuesday, if that index buying doesn't come, we'll just open the April puts, sell the April covered calls as originally planned, business as usual. And off that 2 or 3 day difference, we're not going to see too much of a difference in premium. So that's the plan that I've got for UWMC going forward. And I've always said it sucks that, UWMC has dropped this much on us in such a short period of time. But this is one based off the fundamentals, what we've outlined in our videos, what I've looked into, what I've seen from, the CEO has mentioned, we probably need to announce a special dividend. Oh, I want to do share buybacks. I sleep like a baby with this one, even though, this is one portion of the position and a little bit of a loss on that one today. Didn't realize I was up there the whole time I've been doing this, but we're transparent as possible as we can be here. And we do track all of our trades publicly on a Google sheet that we've got in our Discord server. So anyone who's been following us probably knows we haven't had an easy go of it with UWMC. But overall, with our break-even price around 830, the ability to roll these puts and calls, the covered strangle that we have, roll those over to April and continue to lower it. Also, shout out to AGA Skell, if that's one word, Agaskell, I don't know, feel free to correct me in the chat, but appreciate you following. But going forward with this, I think roughly 820, and what we had in the video might have been a little bit higher of that cost basis. I think we should be able to knock $1 or $2 off that basis into April. Again, we have the potential for another squeeze upward thanks to index buying that could knock all of our call strikes out, get everything called away, have all of our puts expire worthless for a max profit scenario, which would pull a really nice sum of money over the next month or so. But I think that's definitely something that's in play. Fundamentals of the company I think are super strong, and it's something I'm very happy to keep holding long term. And to address the YouTube comment, we got what leaps or calls do we have? And what we're doing here, I know we do have a lot of people who are new to the channel. Everything we do in here is a option selling strategy. So if you want to see the actual position that we're working with, it is on our YouTube channel in the UWMC video. I think we titled why UWMC is the best value in the stock market right now. A little bit of clickbait for you guys. But that outlines the specific strategy that we were using. And then you could also watch the follow-up video where we talk about how to manage a losing position. And I'm sure once 10 days from now when April rolls around and we manage our position, I'll put out another video just to help you guys see and track what we're doing to each and every month to manage these positions. Yeah, like Young Hat mentioned in the YouTube comments here, you can see it on the bottom of the screen also, bottom right, where we have the chat pop up. They're good. I mean, they are one of the biggest, and we have the specific numbers again in that video. I hate to keep referencing the video that we've posted, but they're one of the biggest wholesale mortgage lenders in the country. They've got a really solid business backing them. A lot of the discussion sometimes that I see is, okay, you know, everyone is refinancing right now. How's that going to affect the business? And what's good about this company is they are primarily focused on mortgage originations, I believe. So refinancing isn't really their bread and butter, as opposed to a company like Rocket Mortgage, which we could pull up. They had a real big squeeze the other day. They're more dependent on refinancing, which is obviously super hot right now with the low interest rates. So people are jumping all over that. But that's been a boom for their business, whereas UWMC, you don't have to worry about that being like a one-time thing. Have a super widespread reach. Home buying is, you know, decently affordable in the US right now. I think there's a lot of mechanisms in place that have been put there since 2008 to prevent a comparable crash in the market, housing market that is. So I think this is a super good stock to hold long term, and we put our money where our mouth is on this one. This is the single biggest one we've got right now. I think we've got about 40,000 of collateral wrapped up in this thing, and that's about as big as I am willing to make a position. So I think that says a lot about the research we've done, how we feel about this, and that we're not just trying to, you know, pump some garbage stock. So I think that covers pretty much everything. We're getting to it about an hour and a half on the stream. Probably cut it off right here. We'll try to do this as much as we can. Obviously, it makes it a lot better when we've got everyone watching and commenting and giving us suggestions to go through. So I definitely appreciate everyone who's been watching with us tonight and giving us comments in the chat, both on YouTube and on Twitch. So if you're on one or the other, feel free to, you know, subscribe, give us a follow on there, help us out a little bit, spread the word about what we're doing. But we'll try to be doing this a couple times a week. Typically, we like to do them on Sundays. I was personally a little bit busy this weekend, so I couldn't do it. Thank you guys for tuning in, and, you know, that's all we've got. And Vice Engineer, thank you for the follow. So that'll be the last little call out I give while we're on this stream, and I'll leave you guys with that. Hopefully we'll give you a heads up in the Discord server about when we plan to do this next. But, you know, I have a really good time doing this. I know hopefully you guys enjoy it as well. So we'll try to do this with decent frequency going forward in the future. Appreciate that, Todd, in the chat for YouTube subscribing. And until next time, this has been the Hourglass Trader, where as time passes, we make money. See you guys on the next stream. Appreciate it.